evening, investors, and hope everyone's keeping safe and healthy. Welcome back to our third episode of the Master Talk series, where we learn about winning strategies employed by fund managers. So today's theme is going to be about rise of quant funds, alternative data, sentiment, and predictive analysis. While the debate between value investing and growth style investing rages on, quant investing is slowly but surely grabbing a piece of the investor pie. For the average investor, the best way to access quant strategies is by investing in quant funds. These are basically mutual funds that use advanced mathematical modeling, new age technologies like artificial intelligence and data analytics, and algorithmic trading to identify and execute profitable trades. A key point to notice here is that since human intervention is minimal in the decision making process, these funds can optimally reduce errors that stem from human emotional and behavioral biases. In today's episode, we will be discussing all things related to quant funds while specifically focusing on the winning strategies employed by fund managers. Sounds interesting, doesn't it? Well, without much ado, let's start this episode of the Master Talk series on the rise of quant funds, powered by Refinitiv, leading providers of financial technology, data, and expertise to keep you ahead, and in association with your favorite personal finance magazine, Outlook Money. I'm Deepika Asthana, your host for this session. Today, we have with us Mr. Anil Ghelani, Head of Passive Investments and Products, DSP Investment Managers. Anil has been working with the DSP Group since 2003. Previously, he served as the business head and chief investment officer at DSP Pension Fund Managers. Earlier in his career at DSP, he led the risk and quantitative analysis team, providing quantitative research inputs and buy side credit research on companies across various sectors. He has been a volunteer with the CFA Society India for more than a decade and currently serves as the vice chairman on the board. Good evening and welcome, Anil.
Hi, Deepika. Good evening. Wish you a very warm welcome, friends. Everybody who has joined for this session today.
Perfect. So let's start this session, Anil, with an anomaly. So over the last 1 year, we have seen lackluster performance by quant funds globally. However, in the backdrop of this performance, Indian funds have outperformed benchmarks. So let's hear your view on the reasons for this supposed anomaly.
Sure. See, Deepika, structurally, when we talk about quant funds, it's a slightly generic term, and it can be used for several different type of strategies which deploy quantitative style, which could include certain strategies which are momentum driven, certain strategies which use some macro models, some very different which use high frequency trading strategies. This I'm talking about global markets, like since you raised a point about global. And structurally, all strategies and different managers adopting these strategies always go through certain cycles or periods of out and underperformance. So yes, maybe in certain segments of this type of a quant investing, in the last one and a half years, 2 years, some of these funds have underperformed, whereas on the other side, some funds have outperformed as well.
Right.
Like if we see some of in India, structurally, since you mentioned the comparable between global markets and India, in India, if we see today, there are hardly 5 quant-based mutual funds in India currently. Some of them have been launched even less than 1 year ago. I mean, so structurally, if you see that space is very small, and as I said, within that, depending on the strategy of that quant model, let's say if somebody is following a momentum strategy, somebody is using an approach where they are focusing on, let's say, quality or value, then depending on the underlying cycle, some of these strategies will have underperformed in the last year, whereas some strategies have significantly given a good outperformance.
That's right. Fair enough. I think that is, from that perspective, true for all funds, right? I mean, we should not look at it in silos in terms of just one time period.
Correct. One time and more so, because when we say structurally at the kickstart of this session itself, that when we talk of quant or quant investing or quant funds, within that also, there can be multiple very distinctly different strategies. Like a quant fund applying momentum strategy will have a completely different risk and return trajectory versus a quant fund applying value or for example, a combination of growth and minimum volatility. So that's very important to get clear in the minds of our viewers at the upfront.
Absolutely. So let's, I think one thing let's try to focus on is momentum strategies, because trend following, identifying a trend and then following it is, I think, everybody's hobby in the market, right? And momentum kind of gives you that kind of space when you identify the trend and then you trade with it. But from that perspective, how do you think momentum strategies are currently doing in the market? And going forward, when maybe markets are never unidirectional, so from that perspective, how do you think they're likely to perform in the future as well?
In my opinion, momentum strategies have worked very well, especially in Indian markets, as well as typically speaking, what we have seen in many developing markets. So
Mhm.
if we have a distinction between emerging or developing markets and developed markets, more often than not, you trying to see momentum strategies do pretty well in developing countries or emerging markets. In India, recent times, in fact, we have seen a slight turnaround also, not only
Mhm.
pure momentum,
Mhm.
or it's a combination of certain other factors which are at work. Let's say about 18 to 22 months back,
Mhm.
if you would have seen momentum driven investing, it would have been doing very well. In
Right.
fact, trend following, like you mentioned, very classic word. I mean, trend following versus,
Mhm.
let's say, another belief is people who believe in mean reversion.
Right.
So what we are seeing in Indian markets, because there was a huge polarization that was happening. Whereas in the entire market space, not just large cap, but within large cap, only a small set of quality stocks, investors were just chasing quality.
Right.
So so-called, like, the nomenclature, Ritik stocks or something like that,
Right.
quality type names were only what were driving. And
Mhm.
if you were investing with that momentum driven strategy, but actually chasing the underlying quality or the growth
Also.
of that segment of the market, then definitely your strategy would be doing well
Mhm.
for that time period. But as I said, that structurally, that particular cycle, in fact, as we see the market becoming more broad based and not
Mhm.
remaining polarized, in
Mhm.
that, like now, last about 6 8 months, we have seen much more broader based
Global
rally,
rally. Mhm.
as compared to what was there 1 year ago, 1.5 years ago. So in that broad based rally, it could very well be that not always then momentum as a strategy might be working. But yes, again, it will have its own comeback, where it
Mhm.
will do very well. And just on the lighter side, like you mentioned a good example, that very often people think that yes, momentum investing is one of the best strategies. Completely agree. But equally good,
Mhm.
and there are equal number of followers,
Mhm.
as a, let's say, algo trader or as a quant investor, when you look at these two fundamental differences, like, when we even talk to our friends in this circle,
Mhm.
there is this different sometimes language, and when you are nowadays not in a room, but otherwise when you are in a room, typically you get segregated. Yes, this side of room
Absolutely.
these are all your trend followers, and these are all
Mhm.
the guys of the mean reversion type style.
Absolutely. Yes.
So equally and enough is there for mean reversion type of approach,
Okay.
because we all know and we all understand that, like, there are cycles in the
Mhm.
broader capital markets. Similarly, even in individual pockets or individual factors, there has to be a cycle, and when that cycle is turning, the mean
Mhm.
reversion
Will work.
often, yeah, will burn. Exactly.
Mhm.
Exactly. So, like, even if we look at let's say, just the taking the same example, like Ritik stocks were doing very well.
Mhm.
Now, I'm not saying that now in this last 6 8 months, 10 months, the Ritik stocks have fallen considerably,
Mhm.
but I'm saying that the others even if you look at the large cap space, let's say Nifty 50 stocks, and earlier only those 8 10 stocks were main drivers.
Mhm.
Now even the other stocks
Right.
within large cap, within Nifty 50, the other 30
Mhm.
35 stocks, they are doing more better and playing catch
Mhm.
up with the top 10.
Right. Right.
So
Right.
so that type of a mean reversion and that type of a connect between, how the change happens, because very often when uh, coming to the our specific discussion about quantitative investing,
Mhm.
and let's say one particular factor like a momentum,
Mhm.
in certain situation when that becomes very popular, it results into positions that become over owned by investors who are using that same
Right.
factor.
Correct. Right.
So it's very crucial and very important to understand that you need to even have a second layer of derivative analysis, whereby
Mhm.
you are monitoring the valuation of the factors also. Okay,
Mhm.
now
Okay.
momentum driven strategies or momentum driven stocks,
Mhm.
what are the valuation metrics of those underlying companies now? Is it something
Right.
going beyond certain threshold levels? Then maybe
Mhm.
it's a signal now that maybe that's going to reverse.
Mhm. Absolutely. I mean, I think your point with respect to what you said, if everybody's following the same strategy, it kind of becomes self-serving, right? Because as more people buy it, it goes higher, and then, I mean, then you're right all of the time.
One
So,
is self-serving, other is what I mentioned slightly different is it becomes over-owned by investors using that same factor. So that could lead to a risk also that, now if everybody is chasing that, is it resulting into excessive valuation of that particular factor or those one or two factors? Hence, I said second layer of derivative analysis is required when you are doing even momentum or any factor-based investing. Not just seeing that factor, but looking at the second layer derivative of the valuation of that factor also becomes very crucial on a constant basis. We need to keep looking at that.
right. So, Anil, actually, from what you're saying, would it be fair to conclude that quant models are able to optimally capture that space between price and value? Since you spoke about the second derivative level of value capturing as well.
Sure. So when we refer to value in a factor language, it has slightly different connotation. But yeah, otherwise you are right that in that sense, if your model is designed to work between these two in a suitable manner, where you are assigning relevant weightage to not just momentum but even value, then yes, it will be in a position to capture that suitably. But if you are working with a single factor model, like I remember back in the day when I was a young quant analyst in 2007-8, we used to run a paper trading portfolio because in those days still it was not easy to implement this in real market. So we were planning to do a paper trading first. So we using only one single factor momentum. We used to select 20 stocks to go long, 20 stocks to go short.
Okay.
But it was only one factor, momentum. Now what happened? Exactly what I'm saying. At a point of inflection in the market, when suddenly momentum as a factor changed. So it took very long time for the models to start recognizing that. And in that interim period, 2-3 months period, that particular paper traded portfolio significantly underperformed.
Right.
Because we were overweight only the stocks which were high on momentum. And suddenly the entire cycle changed. So hence my point was that you need to have a watch on the other element, which is the valuation of any factor, whether momentum or let's say even we are using value as a factor. You should watch how the valuation of those stocks are changing.
Understood. Okay, so great. Then let's talk a little bit about the models since we've brought this into the conversation. So
Sure.
I think one of the basic things about a quant fund is the backtesting of data, right? So here there are two things I think we can maybe go deeper into. One is, of course, we use historical data, right? So in these models, how do we account for unpredictable or the black swan events, so to speak, because the models only take into consideration events that have happened in the past, right? And my second question, we will talk more about maybe data. In terms of data is the oil of the 21st century, more tech powered, everything. So, what are the factors other than traditional metrics that we now need to look at in terms of alternative data?
Very good point. So first aspect, like how you mentioned, how does a quant model factor in this kind of a black swan type events? Like black swan event was made very popular after the GFC and by and very beautifully captured in the book by Mr. Taleb. Yes, you are right that structurally history hardly repeats itself in totality. Structurally, black swan events are such that they have very, very rare occurrences, but when they occur, the impact is catastrophic, basically. But being that they are very rare to occur, whether as a quant manager or active fund manager, individually tracking stocks or sectors or themes, it's extremely difficult or crazily expensive to prepare for a black swan event and hedge your portfolio for that. So what happens structurally is that if today, sitting in the month of, let's say, November or December of 2019, some data points would have shown that in March there's going to be a sharp correction. Okay, would it have been possible that somebody will hedge that portfolio? Very difficult or very expensive, because sitting in that period, if you try to buy out, let's say, any hedge in the portfolio or any long dated put options or something like that, it's going to be very expensive.
Absolutely.
And structurally, no model can be it structured or created to factor in this type of very out of the way, like a more than a Six Sigma type event, like Black Swan, what you mentioned. So, in some form or fashion, often for such kind of situations, any quant strategy would tend to underperform. But structurally, there are various other areas where a good simulation can be built in and protection can be created. Like might be that long term fall down in November one could not have predicted. But I will. It's one of topic very close to heart for me. Earlier in my career, I have also been a risk manager, so thinking of risk is also very dear to mind when you are investing. That another similar animal which was made famous after the global financial crisis, after Black Swan, was the grey rhino. It was done by a very dear friend, Michel Wucker. We had hosted it in India last year for a conference. So where Michel Wucker classifies grey rhino as an event which is open for the world at large to see, not like a black swan, unexpected, right? Today, when person sees a swan, you are expecting only black colored swan. That's how you are wired to think. So your models are built, or your mind, even for a personal event, anything is structured as a white colored swan only I am going to see.
Sure.
But rhino grey, it's grey only. Rhino is coming, so it's going to be grey only. So it's an event open for the world at large to see. And only thing is then it's a human bias which sometimes thinks that let me just avoid that, because okay, even if I'm seeing a rhino standing far from me, not necessarily it's going to start charging and coming running towards me. Let's say I'm somewhere in the north of the country where rhinoceros is very commonly found animal. Maybe it's going towards that side where there's some food lying for the rhino. But if my model is well aligned, maybe sometime in December, January, when there was data points coming out that in certain countries like a China, like a connected to China, Hong Kong, or some Japan, some other countries, number of cases of the virus are increasing. What can be the next layer of impact for that? Okay, very small chance, but there is a chance that it can carry on further to some other countries. Exact impact of the magnitude that we saw might be very difficult to predict, but in small ways, this kind of instances or this kind of occurrences could lead to some more relevant preparation in the portfolio. So maybe during the month of January, maybe one could have taken some near-term kind of protection, not anticipating that in March we are going to see such a sharp kind of a reaction in the capital markets and in the physical real economy. But some wiring, some changes definitely could have been incorporated if you have got your structuring correct. So coming to your original thing and to conclude this angle, I feel very strongly whether for a quant model or for you and I taking any decision in personal capacity or an active fund manager doing a stock by stock research, factoring in a black swan event and preparing for it or hedging for it is extremely challenging and usually insanely expensive. But instead of that, looking at smaller pieces of information which could be grey rhino type instances of grey rhino events in some way can be more relevant and more practically implementable. Yes, black swan events also are important to try and identify and capture, but structurally, especially in a this kind of a scenario, very challenging.
Understood. Agreed. Actually, I think I think my biggest takeaway from this is that it's important to recognize the risks and not always possible to judge the magnitude of the risk, right? So, like you said, in January, let's recognize the risk and take some proactive measures to mitigate the impact, not really fully understanding the magnitude of the impact.
Yes. And as I said, the difference being in November, there was not so much information yet available.
Correct.
Hence, I was saying that at that time it can still be thought as a black swan. It's a unexpected, right now. Normal case, little bit virus and all, it was seasonal thing. Many times it happens in those part of the world, unfortunately. I mean, whatever you think of it. But by December, January, it was already coming out. This is a very unique, different strain of virus, very challenging to cure and curtail. So it had become a grey swan at one stage before it actually hit us. That's the difference between, like why I said as an example, October, November, and then December, January, like that, the distinction between the two. That by the time then that information is available and open for the world at large to see and react if you are able to react. That is the distinction. Those events, yes, certainly some models can capture suitably and assist the portfolio managers to take correct protective action. See, this again, this last point I'm saying could not be only for quant managers, but it could even be for quantamental, like active managers using quant strategies, or active manager using risk management incorporates risk management in their investment framework, quantitative analysis in that framework, that way.
Certainly, because risk is everywhere, right? So
Yeah.
we all need to deal with it. Great. So you spoke about information, right? I mean, I think that is the basis, the foundation for everything all fund managers do, whether it's quant or passive, any fund manager. Information is important. So from that perspective, what kind of data is sacrosanct to quant models? And even more importantly, now, we're living in a world where social media and sentiment analysis is becoming more and more important. So how do we incorporate this into a model?
Very important point, Deepika. And structurally, yes, you are right that uh, 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 one needs to have very high quality of data, and nowadays there is a large amount of ancillary data, or what often we call in technical language, like in investing world, as alternative data. All data we call it, or some people call it big data. All data is a more slightly commonly used word in investment industry. So one is this type of financial data officially released by the company in terms of their company filings, balance sheet, P&L, cash flow, etc. And based on your expertise as a portfolio manager or as a person tracking the company, you can mix and match some ratios which are captured from only balance sheet, some only from P&L, some from a combination of balance sheet and P&L and cash flow, so as to give a better understanding of the any financial shenanigans or any red flags. So that is your expertise, how you ensure you develop a very risk model, very robust model to capture the company's underlying fundamental as well as technical analysis. And then this other part of the data which you mentioned, social media, or now with further enhancement today, just yesterday I was chatting with somebody, and some young friends in the industry, very often I talk to within our the CFA network, and they were saying ke, अरे अनिल भाई आप इंस्टाग्राम में ज्यादा एक्टिव नहीं हो आजकल. आई एम देयर बट नॉट वेरी मच. नहीं नहीं सर, उसमें बहुत अच्छा कभी कभी एनालिटिक्स भी मिल जाता है about like how trends are evolving. I said, yeah, I will maybe try to look it up. So what I'm realizing, and this is going to be the future of even the way in which investment management will use this kind of data, is that how emotional data or emotional aspects are being captured. When I mean by emotional, what I'm saying is that what I spoke in the first part is the financial data. Right? I'm the company. I'm sitting in my headquarters in Delhi or XYZ. These are my factories. These are my or whatever my outreach, and this is my financial data I'm generating for you to analyze. Now that company's users, vendors, blah blah, everybody is absorbing them, and then they are putting on social media, oh wow, wonderful product, oh no, this I didn't enjoy, blah blah, whatever. That is the what we call as emotional data. So the classic combination of emotional data with financial data will ensure best financial performance.
Right.
How emotional data will be captured today is happening, but it's still very, very challenging. Because today, if you have to just capture data from social media handles or do some web scraping and try to see how many people have said good things about, let's say, Maruti's new car getting launched, for example. Right. Just example, or let's say, for example, if one wants to see that where are the kind of new developments happening in electronic vehicle side. So suppose you want to see Google trends of how many people are now searching for electronic scooter versus petrol fired scooter, basically. So that can give good inputs to the portfolio managers, that how I can ensure or incorporate this type of a alternative data, or in some form little bit like unstructured data, to form some judgments. Right. Now at the current situation, at least as per my limited understanding, to incorporate this type of unstructured and alternative data into a quantitative model and run it is very challenging, because it's unstructured, as we are discussing today. It's very challenging because you need to have specific rules being coded and established, which can't be so easily done in this kind of unstructured data. But certainly it will be useful going forward in terms of understanding better trends, in terms of understanding investor or consumer trends about certain products, certain service, certain category of services, certain shift in consumer behavior. If people are trying to capture the early shift or change towards electronic vehicles, maybe these are the good trends to observe. Not just Google searches, how many people are searching about electronic scooters, but social media trends was how everybody are reacting.
Reviewing
like 5 people have written, oh, I have to bought an electronic scooter, and others are in their friend circle are saying, oh, how was it? And he or she is giving good review. First class, boss, low cost, easy to charge. Go and buy. Go and take a look at the dealer. So those are the trends which can help in picking up more information and incorporating them in your judgment or decision making process.
Sure. So, so then coming back to this bit about unstructured data, because it's becoming more and more relevant today, right? It's not just in investing, but I think across sectors, data, unstructured data is becoming important. From that perspective, do you think quant fund managers or quant funds in general can, going forward, increase their use of technologies like AI and maybe data analytics to make more sense of this unstructured data?
Yeah, definitely. So in that, the AI as well as ML, the machine learning and artificial intelligence, they will become more and more powerful. In fact, in many of the global markets, it is already being done in a very big way. There are large teams, specialized in this kind of area. Gradually, it will, I think, definitely get incorporated and enhanced over here also in India. In the sense of uh, utilizing that and making sure the your current models or your current way of investing incorporates that. That's the key. Like today, if you are given large set of data also about this kind of social media trends or Google analytics, what will you do with that and how you will incorporate? That is the key.
Right. Agreed. Absolutely. So then, I think let's also understand. So we know data plays an important role. We understand that there are various strategies that quant funds can follow, and risk is also imperative.
Sure.
One more thing that then I would like to really understand from you, because you have so much experience here, is how does one go about building robust quant models?
Sure. See, I think in some way it's not like a something very like eureka moment, like Archimedes was that, like suddenly in the bathtub suddenly some idea came into the mind and jumped out and ran towards his workshop and did it like that. So it's not like the suddenly some quant manager is sitting on his or her desk and she thinks of some unique idea and then runs to the computer and starts coding that model. Structurally, when you look at that, there are certain predefined buckets of information data, and based on that, how your investment style or your investment philosophy you want to incorporate in that model, that's the key. So if I were to, in a very simple way, define first of all what are quantitative parameters or what are factors or factor investing. When we say factors, they are nothing but the risk and return characteristics of each individual line item or each individual financial security.
Okay.
Right. So the risk and return can be sliced down into multiple segments.
Sure.
So, or in a very simple example, today, whatever food we eat, right, you can slice it down. Okay, this food has given me X number of protein, X number of carbohydrates, blah blah. Now, when I'm approaching a dietitian, let's say in preparation for the marathon in Mumbai next year, she has told that okay, X number of carbohydrates, Y number of proteins, and Z number of whatever. I'm not dietitian, sorry. Then each and every food that I plan during the day, I will not look at the item. What item I'm eating. I'm going to look at now this is what I'm eating for lunch. So I finished X quantity of carbohydrates, Y of this. I stopped talking about I had 2 chapatis and one sabji. I'm saying okay, I finished X protein and Y this. So how is it happening? There is something which is defined top down. Okay, you need to have X only protein and carbohydrates, for example. Then everything you are doing sliced down everything else and only picking up that much part. So like that, before a quant strategy or quant model is defined, suppose the particular okay, these are the two factors you have to consider. For example, that you have to consider quality, growth, and value. For example, just I'm saying three
Sure.
factors you should consider. For any simple investing, what would you say? If you buy the company, it's got a good quality of earnings,
Right.
and it has a good growth potential of those earnings. The earnings quality is there, it should have growth potential, and that company is available at a reasonable value. For in a simply put, if I was to define
Sure.
investing basic principle, as I said in the beginning, a quant model can be one or multiple factors basically.
Sure.
So let's say we define one model with these three factors. Now everything depends on that, how you define the individual parameters of those factors. That for the quality, what all factors you want to see. You want to see how the balance sheet strength is, how the P&L is, how the cash flow to earnings, certain ratios are captured. Then the growth part, and then the valuation part. So that's how it typically happens as a top to bottom type of a thinking, and capturing the relevant data and building upon your model. Like,
Sure.
how like a successful model can be built up. That first you define what are your core investing philosophy or core investing rules or principles. Then you dissect them like you do for a food item into different factors, two or more or one or three or whatever, and then you create your model. To a specific question, how to create a successful quant model, I would define it like this. First, create your top-down rule or investment philosophy, then have the grip to dissect it into one or two or three factors which are going to be defining that particular strategy, and then go about and build it up very easily. Very simple.
Thanks. I think that will be very instructive for, I think, everybody who is looking to, foray into quant investing, because it's always, I think, I'm sure you will agree, had some sort of an appeal, right? That
Sure.
if you can break it down into factors and numbers, it seems so clean cut from that perspective, right? And then there are rules. So as long as you follow the rules, the assumption is that
Yes.
you will make it to the finish line, right?
Yes.
So, great. Thanks.
So on the lighter side, it will. I hope that this show, Deepika, will not help only people who are interested in quantitative investing or building a career in quant investing, but also, as I mentioned, free advice for Mumbai marathon running also.
Right, absolutely,
That's on the lighter
absolutely.
side.
See, everybody likes that. एक के साथ एक और मिल जाता है, तो it's great, right? Great. So I think maybe next up we can just discuss your perspective or your opinion in terms of where quant funds, and maybe more from the perspective of India, where quant funds are headed, and is the future going to be more of a machine versus humans kind of scenario, or is it going to be machine plus humans?
Oh, well. For that, I think it's very clear cut. And in my mind, I am very clear, Deepika. Whenever I am making any decisions, whether it's about any personal choice or about any business decisions, unless it's it's selecting some particular stock. But otherwise, I always prefer to use the power of and versus or. Okay. So if you go with and, the results are often very powerful. So I believe strongly it will be humans and machines. It's not going to be machine versus human. I mean, so it's because one needs the other. Each needs the other. Otherwise, it will be a disaster.
Correct.
So it certainly has to be a combo. I mean, of the two. Why disaster? We have seen in some global markets that if there was a only machine-driven thing which was running some high-frequency trading and something went wrong, suddenly it corrected, and it could result in some very awkward situation in the capital markets.
Right.
And why? I mean, what is the reason for that? I mean, likewise, if you are doing only human, I mean, you as an individual, you are a, let's say, best stock picker, but you refuse to realign your old school thinking and adopt to certain inputs from machine, or enhance your data inputs, like collecting this type of emotional data also, emotional performance data. Then it is going to be more and more challenging for you, and you might be a little bit marginalized, because that's how things are changing. So I strongly feel that it has to be a combination of both. So it will be humans and machines. Humans will bring their thinking, intellect, and keep realigning that on a periodic basis into the model. Right? When one model is made, it's not, it can be, it's like a holy grail of investing. So one would create the model, and then I would just sit back and relax and go to the Mauritius and set up my thing over there and be cool, right?
Right.
Any model that is built also needs a constant ongoing review. I'm not saying it should be tweaked and changed every day, but it needs a human touch again to keep refining it, keep reviewing it. Likewise, on the other side, like you will need the machines to help the fundamental analysis also, like which will give good factor inputs, which will. I'm saying, if nothing, even just some good technology to capture your old history of thinking or your old history of data. Today, when analyzing a company, you might want to see historical data, even if you want to just do a cyclically adjusted P ratio of the company or earnings cycle of some company, how it is seen. You will need that type of a robust technology to support that. So definitely for that, my response is very clear. How use the power of and versus or. I feel very much it's going to be both combination of machine and human. Quant funds, the other second question about how I see the way ahead for quant funds, most certainly they will be gradually increasing in popularity.
Okay.
See, there is no magic formula or secret sauce which works all the time, like I said in the beginning. Like this, that reminds me of a very, very famous movie. Little bit on the digressing away, but like it is called as Kung Fu Panda.
Kung Fu Panda.
Where the panda's father bole boss, I make this very famous soup, and like there is secret sauce. And at the end, it comes to the light that there is no secret sauce. It's your own effort and your own thing. So likewise, I feel very strongly, Deepika, that for even quant funds, there can never be any one single secret sauce or magic formula which will work at all times. Quant funds also will have some situations where they will underperform in certain cycles, certain periods of time. So more than the success of the model or that number or count, it is important to enhance the awareness. Like for example, today this session which we are doing, okay, one of the main purposes is to increase the awareness for people to understand what exactly we think of quant investing. It's not just high frequency investing, or it's not something randomly just going on and off. We are not even understanding, or it's not some black box.
Sure.
Like we explained in simple term. Today, the marathon runners of the city also will be able to relate to what quant investing is. Just example I'm saying. So as the awareness increases, automatically investors' mind will get clear that in what circumstances or in what market scenarios this one XYZ quant fund or ABC quant strategy will work well for my portfolio, and they are definitely going to go for that and add them in their portfolio.
Right.
So as awareness increases, proper understanding enhances, it will increase the acceptance and growth of the quant funds or quant strategies, whether in whichever format like you think of it.
Sure, absolutely. So, if you're talking about the power of I think let's also extend that to partnerships, right? So when you consider a strategic partner for quant funds, what are the attributes that you would generally look for?
Sure. So see, structurally, when we look at a partner, I mean, it could be in the form of like a partner for multiple things. Like, one of the first thing what I mean you could think of is a partner for the data and running the quant model, doing the back testing. My go-to partner for a technology platform, or how I would do my coding. So 2 or 3 key things that one would look for is that the particular platform or partner should have a very robust platform for absorbing the data, large quantum of data. So making sure there are long historical time series of data available, which are good quality data. So that is crucial, because if I don't have good quality data, just because of some number going haywire, my end result can be completely different. Today, if I'm looking at some companies' historical cash flow movements, or I'm looking at the how the top line has increased and connected to that, how the cash flows have been changing. But if some of those 2 data points out of this 20 years history I've seen are incorrect for whatever reason, I will never come to know, because I'm just relying on the data. So data quality and quantity, I mean, both are very crucial. We need that what we call as point in time content, and we need to ensure that the way in which the data can be fed to us as the user also is very seamless. sorry, I'm
Yeah.
going to very technical aspect, but like there are these file transfer protocol, अपन बोलते हैं ना,
Right.
FTPs or APIs, like so let's say if there is some particular technology partner with whom whose services or whose platform you are using, but if that cannot talk to
System.
my technology platform or my system, so my CTO will say, "Nahi boss, you can't use this." Suppose, for example,
Right.
so it needs a very robust connectivity and customizability, for this kind of thing, and it should be very easy to use and very flexible. See, today I'll be very honest. We don't want only people with technology background to come and run that. So you don't need just a coder. You need to the partner platform that is being used should be such that it can absorb simplicity, like a good user interface. Like
Right.
earlier in the day when you were using computer, you need to have that MS DOS command language. You need to remember, right?
Right.
dir/p. I mean, I don't even know, but and then graphical user interface. You just press a button. Okay, I want this. Like that, even this, no doubt some syntax and some coding, Python, वगैरह, some areas are important. I'm saying all this also is history. People, young professionals today, like for me also, I sometimes feel that I need to learn more languages.
Right.
So like I'm already starting to try and little bit get my hands around newer languages called Julia, for example. Python is very important right now, but might be 5 years later in future, maybe these are even more powerful and faster and better languages one has to start learning.
Right.
So that has to be there, but still the platform has to have the ease of use and flexibility.
Right.
Let's say suppose suddenly we just decide that we need to while running a model or while building a model, we want to build in a cost of frictional trades, trading cost or frictional cost, because when I actually implement it, I might pay some brokerage,
Right.
some slippage in the execution. So suppose we decide, no, there is a request from top down during the investment committee that you have taken a frictional cost of 1%, but that's not seeming enough. You need to take the frictional cost to 1.5%. Now, what is my team going to do? Will they go back to whole of the analytics and change everywhere 1% and run it back again with 2.5%?
No.
Not feasible. So the platform should be powerful enough कि okay, ठीक है ना अनिल भाई, आप आ जाओ, बोल दो कितना change करना है आपको, 1 का 2.5 करना है, okay, बता दो मेरे को. I mean, sorry, just put that number over there, and the entire workings, the model will ease of into implementing, accounting for this kind of changes. That's crucial when selecting this kind of a platform partner. Yeah.
Perfect. Superb, Anil. I think my takeaways today have been immense, but if I'll just sum this up for our viewers, and then you can definitely interject and tell me whatever I might have missed. Yeah. So I think we started off with the fact that there are several types of quant strategies, so we should not put quant in a certain box, right? Momentum is one type of strategy that's followed, but there are many other strategies as well, and one needs to be aware what these strategies are and then invest accordingly, right? Then we also touched upon the aspect of risk, black swan events, and gray rhinos. And I think the conclusion from that point was that it's very difficult, one, of course, to envisage the magnitude of big risk events, but it's also very expensive. So then it's better to be a little proactive in spotting risk events and in some way or the other incorporating it into our models. And like you rightly said, a lot of what we discussed is not applicable only to quant models, but I think to any fund manager, any investor who is creating a trying to create a robust portfolio. Then on, I think the next point, which is essential to our conversation, is the importance of data. There are many now reams of data which is available. There is our traditional data metrics, and now there are also new data points, unstructured data, which is coming up, which also means that technologies like AI and ML are going to gain more traction in the investment world. So it's no longer just for the coders and the technologists, but also for fund managers. And the most important part, I think, at least for me, was how to create a robust quant model, or like you said, an investment model at large. And here, I think what you said in terms of the first and foremost point of aligning your own philosophy with the model is extremely important, right? Because I think that's where you kind of get rid of all of the biases, because you're well aligned with the investment model. And then from there on, I think the whole idea about breaking your investments into factors, right? Instead of just talking about stock A, stock B, stock C, but the different factors which contribute to the movement in the stock prices and the companies. We need to look at that. And then, of course, at the end of the day, we need to be aware of what the models are all about. And the future is definitely going to. I like the power of and actually,
Yeah,
like you said, a lot of what we've discussed today is not just about investing, but just generally in life as well. Instead of having the dichotomy of either or, if you have an and,
yeah,
I think you can definitely check out more avenues and do well.
yeah,
So
yeah.
that's been and yes, of course, your main view in terms of as awareness of quant funds increases, we will be seeing more investors probably getting interested in quant funds.
Sure.
But that's my summary. I would still like you to maybe just give us a few closing words.
Sure. I think no, you summed up very well. I think it's very important that as an investor, once you are aligned with your style of investing or what you want out of this particular piece of your portfolio,
Sure.
you could have certain advisors guiding you. That is always best. That okay, some percent of your portfolio has to go into fixed income, some into gold, some into real assets, and some into equity. Within that, some part, let's say, take it to this kind of a quant strategy or quant funds or quant models.
Mhm.
And then within that, once you are thinking right or you are aligned to how you want to build it, that okay, right now I feel in the market right now there is going to be a shift, and now instead of like X factor, let's say value is going to work, for example. Or in Indian markets, structurally, we have seen that always momentum and low volatility means min
Mhm.
vol or
Mhm.
and value. So you then decide and select that particular fund manager's strategy or that particular quant strategy, which
Mhm.
gives you the best combination of which factor or which one or two factors you want,
Right.
and
Mhm.
then take the comfort and go ahead with that.
That's right.
And yes, I certainly believe this power of and in
Mhm.
fact I often conduct short polls on my social
Mhm.
media platform. So I think this is you have given me in fact a good question today in the evening. I will put up that I'll try to put up some similar type of a message into a poll, and let's see how the outcome comes.
You know what my answer is going to be.
Yes, absolutely, absolutely.
Perfect, perfect. Lovely, lovely. So, with this, we come to the end of today's episode of Master Talk presented by Refinitiv, providers of financial technology, data, and expertise to keep you ahead. Thank you, Anil. Thank you very
Thank you
much
very much. Yeah.
for joining us today and sharing your thoughts. Uh, it's been very value accretive for me personally, and I think our viewers and all those present will definitely agree.
Sure, I'm sure it
Um,
will be. Yeah, it was superb set of questions. To be very honest,
mhm.
not very often I've come across such depth of questioning. So I was just a little bit, I mean, very much alert in terms of oh, now what's the next question going to come. So I think it was a very engaging chat. I really appreciate that.
I'm glad you enjoyed it. And viewers, I hope you enjoyed our conversation today as well. And thank you for sharing all of your feedbacks and comments. If you have anything further to share with us, please do not hesitate and write to us with your suggestions or questions at editor@outlookmoney.com. And we will be back soon with the fourth episode. Until next time, stay safe, stay strong, and keep following us. Thank you.
Thank you.